Standard cost accounting and variances. This presentation will discuss standard costing and variances and the problems it brings about by looking at a brief case study and determining what application this topic has on managerial accountants. Standard cost accounting is a costing method used to account for the costs of products, operations, or jobs based on a benchmark for direct materials, direct labor, and manufacturing overhead. Standard costing uses standards, budgets, or estimations to determine the appropriate cost to apply to the product or job. These standards that are determined are then compared to the actuals at the end of a period. Variance analysis is identifying the differences between the standards and the actuals to find the root of the change for managerial accounting purposes. Variances can occur in both price and quantity, each of which can result in either a favorable or an unfavorable variance. A favorable variance is generally one that increases the net income, and an unfavorable variance is one that ultimately decreases the net income. The uses of variance analysis include performance evaluation and helping management to form strategies to meet their incentives. In a case study of Schneider Electric, we see that their organization uses standard costing and variance analysis to provide feedback and make managerial adjustments internally. Schneider provides energy and automated digital solutions for efficiency and sustainability in other organizations. Direct material costs make up the majority of the company's manufacturing costs, so managers pay close attention to the standards, the actuals, and the variances between them to avoid the misuse of materials. This energy company uses materials such as copper, steel, and aluminum, all of which can be costly if they are not used to their fullest capacity. In this case study, we see that variance analysis can be very beneficial to the company's net income because these wasted materials can be costly. Variance analysis is helping identify the wasted materials for this organization. The analysis of variances can affect the success of the company as a whole. With the review of the actuals compared to the standards of both price and quantity, accountants can determine the price variances as well as the quantity variances. Standard costs and variances can also show management an overall spending variance, allowing them to make adjustments where they see fit. A good variance analysis can increase the quality of the product or service, the efficiency of the work put in, and the overall productivity by identifying or preventing problem areas. Variance analysis can reflect the performance of departments, employees, materials, and more. In developing the standard costs to compare to the actuals at the end of the period, management can more closely regulate and be aware of what is going into the cost of a product, and with variance analysis, how it can be improved. Standard cost and variance analysis give managers an opportunity to focus on other issues than just cost and production quantity as well, and can allow them to be notified when there is a concern through the variance analysis process. Cost variances can also be a very beneficial tool in performance evaluation as long as the standards are being calculated and used appropriately. Caution: there are some potentially harmful implications of using cost variance analysis that we should address. The accuracy of the variances and the variance analysis rely on the accuracy of the standards and the measures used to calculate those standards. The problem with variance analysis is that they can also be deceiving. In the case study of Schneider Electric, the standard of what it should take to make a product is calculated by the company's engineers. The accuracy of this computation is vital because managers at Schneider Electric are more than likely going to be making some big decisions based on how close the actual is to the calculated standard. Total variance is a combination of price variances and quantity variances. If the root of the variance is not discovered during the analysis, management can misinterpret a low total variance because of how the numbers can cancel each other out within an equation. Another area of drawback within the topic of standard costing and variance analysis is the observation of what favorable and unfavorable variances are portraying, because they do not always show the whole picture of the issue at hand. Going back to the case study of Schneider Electric, managerial accountants can be observing a favorable variance, but that could be due to the use of low quality materials that could cause very unfavorable results in the long term. So all in all, variance analysis and cost accounting must be done appropriately in order for it to be effective. Thank you for listening to this presentation, and here are the references used in the research process of this project.